Good morning, everybody. Thank you for joining us for today's Small Business Bootcamp. I am Robert Theobald, Small Business Ombudsman and Vice President of Small Business Services. So one of the things we like to do when we start these out is please post up in the chat where you are tuning in from. Again, post where you're tuning in from in the chat. We like to see where everybody's from, whether it's throughout the state, sometimes other states, sometimes even other countries. So we've got some Mesa, Arizona, Scottsdale, Glendale. All right. Again, if you're just joining, please post in the chat where you are tuning in from. Kingman. Excellent. All right, well, we're going to jump right in. Got a great day today. So as we like to do, I like to start by first thanking all of our community partners. We could not do these webinars without them, their time, their effort, and their expertise. They are willingly giving back to the community to help small businesses be stronger and more efficient and productive. So we can't thank them enough. If you're new to the Small Business Bootcamp, it's designed to help small businesses prepare, plan, and grow. It is not only the Tuesday morning webinars like today's, but we also do workshops, lunch and learns, virtual lunch and learns, virtual workshops at other times of the day and different times during the week to help support small business, various topics. And so it's a comprehensive program to help support small businesses. One of the great things with the bootcamp is the content library. So all of our webinars we record and we post them in the content library. And so we have well over 300, probably closer to 360 recorded webinars or workshops that you can access at any time. You can watch the materials, the presentation, or you can download the slide deck. We try to include those as often as possible as well. So there's additional materials to help support you with the topics. Excuse me. So the ACA also has a number of other programs to support small businesses. These are just a few. You can find all of them at azcommerce.com/programs, where we've got a comprehensive list of all the programs that we provide to help support business throughout Arizona. One of those programs that we like to talk about, we like to talk about all of them, but we like to highlight the Small Business Checklist. This is an online interactive tool that helps entrepreneurs and small businesses and even large businesses identify the commonly requested licensing, registration, and compliance requirements at the local, state, and federal level. So if you're just getting started, this can help you identify what you need to do as you get started. Or if you're an existing business expanding into new areas, this will help you identify those licensing requirements and those new areas you might be going to. It is a great resource. You can scan that QR code and it'll take you to the checklist page. And we also have on our checklist page, when you go to that homepage, you'll find Sally, our virtual assistant. And Sally, using her abilities in generative AI, can help you identify some of the information on the checklist. And if you need to get into more detailed information, the checklist has all that information. So we have two options to help you get the information you're looking for. We encourage everybody to give Sally a try and share your feedback so we can make Sally the best virtual assistant possible. So real quick, some updates. On November 6th, we are having an in-person workshop here in Phoenix at the ACA offices. It is hosted by us and the Phoenix Business Journal. We'll put the registration link in the chat for you if you're interested. It's an in-person only. There will not be a Zoom component to that workshop. It's from 8:30 to 11 a.m. And then we're going to post a link for the Federal Reserve Small Business Credit Survey. And this is a really good survey. We encourage everyone to fill it out. What this will do is not only provide the Federal Reserve information about small businesses and your funding and credit and so forth, but if we have enough from Arizona fill it out, then we can get state-specific information as well. And so we are glad to partner and share this information for the Federal Reserve. It's a very good survey with very good information to help support businesses. So here's a quick look at our upcoming sessions. These are the next 3, but we are scheduled all the way into December. And we even have some for January scheduled and ready to go, because we've got great lineups ahead of us. We've got a great presentation today as well. So with that, well, first, as I mentioned before, with the boot camp, we have lunch and learns and webinars and workshops. So the Phoenix Business Journal, as well as workshops. And on November 14th, we have a lunch and learn. It's a virtual lunch and learn with the U.S. Patent and Trademark Office to talk about trademark essentials. So for small businesses, this is really key to make sure that your trademark information is done properly. We've got a great presenter, and that will be at noon on Thursday, November 14th. So join us for that. And with that, we'll jump into today's presentation. We have Jonathan Mann. He's a financial planner with the North Place Wealth Advisors. He's been with us a few times before. We're glad to have him back and talk about doing some planning ahead for your business. So with that, I'm going to stop sharing my screen and turn it over to Jonathan and let him take over.
Hey, thanks, Robert. I really appreciate that. Let me get my screen shared over here and make sure that we're all set. So we're going to be using chat today. So if you guys, please, that's a great way to ask questions, to reach out to me. I'll also have some different questions throughout the workshop that I'm going to go ahead and ask as well, just to make it a little bit more interactive. So I'm going to start off with just kind of a quick question. The topic we're going to be talking about is retirement plans for small business. So I'd like to know, with those that are in attendance, do you currently have a retirement plan set up already? So if you can go ahead and just put that in chat. Yes, if you have a retirement plan, say yes, maybe the type, or no, you don't, or you're looking to do that. So if you guys can quickly throw that in chat, just kind of where we see there. Okay, we got 401k. All right, we got there. Okay. All right, excellent. So appreciate the responses. We want to make sure, as I said, this is interactive and it's two-sided. So if I'm going through this presentation, please go ahead and stop me if you have questions, and we'll go ahead. A little bit about myself. I am a financial planner. I've been doing this since about 2005. I work with a team of partners, and we work with small business owners as well as individuals and helping them plan for the future. One of the things that we specialize is in helping businesses and business owners set up the right retirement plan for themselves. Now, today I'm going to be speaking mainly about defined contribution plans. So defined contribution plan is basically when we're the employees, but not always employees. We'll talk about one where it's primarily employer funded, where the employees are providing contributions. So we're going to go over those. I'm not going to be talking in a lot of detail at all about defined benefit plans. And so if that's something you're interested in learning more, we may have another topic in the future on that. But today we're going to be primarily talking about SEP IRAs, simple IRAs, 401ks, multiple employer plans, profit sharing. So the first thing that we look at is why. Why is it important? And it's actually, they've done a survey. So with this survey done in 2021, they pulled employers of different sizes. And so if you look in the small category, about 69% of employers felt that it was at least somewhat important to have a retirement plan. The larger the company, the more important it was that the employers felt that they had a retirement plan. Now, on the other hand, when we look at those seeking employment, about 84% of employees felt it was important for their employer to have a retirement plan. And so what I want you just to consider is, why would you want a retirement plan, or why do you have a retirement plan? Things that I've seen as far as the reasons why is one of the primary reasons is employee retention. And so employee retention can be very important. The cost of training a good employee can be very expensive. And so having that retirement plan can be one of the things that help you retain good employees. I've also worked with a lot of small businesses where the employer wants to have some tax benefits. So setting up a retirement plan can help be more tax efficient in a small business plan. So just start thinking about what are some of the reasons that you may want to have a retirement plan. And as we go through the different plans, your thought process and why you may want to have one will help you figure out maybe what the right one is for you. Now, I'm going to be referencing several different sources. I'm going to also be providing a copy of this brochure later on. Afterwards, all those that attend will send an email out to you so that you can see it. But American Funds provided a pretty good brochure that we're going to be referencing throughout this presentation, where we can learn a little bit more about the different types of retirement plans. Now, in their brochure, what they do is they start off by asking a few questions. The first question that they ask is, do you have employees? So if I can kind of get an idea, we'll do another quick poll question is, how many employees do you guys have? Are you a sole proprietor with one employee? Do you have 5? Do you have 10? How many employees do you guys have to help me get a little bit of idea of the audience size? Okay, we have about 50, 4, 2, 100. Excellent. So we got people all across the board. So the information I have is going to be excellent for people in all these different categories. So the first thing that we look at is do you have employees? That's an important question. And the next thing is are you willing to make a contribution as the employer into the employees' accounts? Okay. So if you decide that you want to make a contribution, that's the next step as far as helping you choose which type of plan that you want. Now, the following question that you're going to have is, are you looking for a plan that has low cost, easy to administer, or are you looking for a plan that has higher contributions limits or has more plan flexibility? So we're going to get into a little bit of these different designs and plans that we have. The first plan I'm going to focus on is going to be the SEP IRA, or the Simplified Employee Pension Plan. We see these primarily used with employers that maybe have 1, 2 employees. And the reason why is these are 100% employer contribution. There's some nice benefits when it comes into these plans, is that you can put up to $69,000 per year in there, which is 25% of the participant's income is the max contribution. The other nice thing about these plans is that you can actually contribute in these plans all the way up until your tax filing date. And so if you were planning to you could wait until the tax filing of this following year to make a 2024 contribution. So oftentimes employers will do a look back and say, hey, I wish I would have funded something, and they're going to use the SEP IRA because of the flexibility in it. The disadvantages in a plan like this is what you give to one, you have to give to all employees that qualify. And so if you're giving a 10% contribution to yourself, if you're the employer, you also have to give a 10% contribution to all employees that qualify. Now, the other qualification rules when it comes to a SEP IRA, all plans have little different qualification rules that you can determine. But a SEP IRA is what they say is if your employee has been an employee for 3 out of the past 5 years, they have to be able to participate. Now, there's flexibility in this. You're designing the plan. You can make it so that everyone's automatically eligible, or you can put in these restrictions. You also can put in age restriction up to 21. So you could say all employees have to be at least 21, and they would have had to be employed for at least 3 of the past 5 years. So benefits of a SEP IRA is you can contribute to it up until tax filing. You can make a contribution up to $69,000. There's no annual filing, so you don't have to do 5,500, or you don't have to worry about if someone makes a larger compensation versus the lower compensation employees. The disadvantage is there's no flexibility. What you give to one, you have to give to all, and you have to do it each and every year that you participate in it. So there's some basic information on a SEP IRA. Does anyone have any questions on the SEP IRA before I kind of move on? All right, and I think with the size of the companies we have, we'll probably focus a little bit more on the next few categories. The next category that we have is a simple IRA. So simple IRAs, why do people pick them over a 401k? One of the main reasons is that the cost can be a little bit less because you don't have to worry about annual filings. You don't have to worry about filing a tax form 5500. And so there's some great benefit in that, a little easier of administration. Now, with the simple IRA, there's two components to it. There's the employee contribution, and then there's the employer contribution. So we'll start off with the employee contribution. So employees can contribute if your company has less than 25 employees, you can do up to 17,500. If you have over 25 employees, then you only can do up to 16,000. So employer size does make a determination on the simple IRA. The other part is if you have employees that are 50 or older, they can do up to $3,500. So if you have an employee and you're less than 25, they could actually put in about 21,000 a year, including the catch-up contribution. So all these contributions for the employee have to be done in the plan year. So they have to be done up by the end of December. These contributions are typically run through payroll since they're employee contributions. And then with the recent Secure Act 2.0, they've actually made it for simple IRAs that you can add a Roth contribution. Now, unfortunately, not all companies are up to allowing employers to add a Roth there. So you have to make sure that the company that you're using to work with can do Roth IRAs. But the nice thing is with the new Secure Act, simple IRAs can be either a traditional or pre-tax contribution, or it can be a Roth or post-tax contribution for the employee. Okay. Other questions, other parts about this is there is an employer contribution that is required. Okay, so the employer contribution can either be a dollar for dollar match. So if an employee puts in 1% of their income, the employer, so if the employee puts in 1%, the employer has to put in 1%. And that goes up to a 3%. Apologize for that. That goes up to a 3% contribution. So if an employee puts in 5%, the employer is only required to put up to 3%. So that is one way that an employer can contribute. The other way that an employer contribute is they could say they're going to give a 2% contribution to every employee, regardless if they contribute or not. So there is some flexibility in the contributions when it comes to the employer side of things that you can consider and that you can design, but there's not a lot of room between these things. Now, the other thing about the nice thing about these plans is there's no top heavy rules. And we'll talk a little bit more about top heavy rules when it comes to a 401k, but with these plans, there's a lot less administration, a little less compliance because of those things. And so it can be a little bit easier place to get started if you just want to start off with something a little bit simpler, a little less fees inside of there. So eligibility wise, you can put some restrictions on eligibility. One, you can definitely put in that age restriction up to 21, similar to the SEP IRA. The other eligibility rule that you can put in there is that the employee had to have made $5,000 in two of the past, in the $5,000 in the past 2 years. So if they made $2,000 in a year, so let's say in 2023, they made $2,000 and they worked all of 2024, they would not become eligible until 2025 because 2023, they didn't make enough. Now, if they made $5,001 in 2023, and then they work through 2024, then they're going to become eligible, right after that. So just understand there's a little bit of flexibility in the eligibility. You can make them immediately available to contribute inside of there. So those are a few of the things for a simple IRA. So kind of summarizing it up, the benefits of a simple IRA is that there's a simple match that you can design. There's a little bit lower fees when it comes to a 401k. There's less administration or fiduciary responsibility compared to a 401k. The disadvantages of a simple IRA is the employees are immediately vested. So what vesting means is once you give them the contribution, that money's their money. And so if employee works for you for a couple of years and then they decide to leave, they get to take 100% of their contributions and 100% of your contributions with them. So disadvantage is one, as I said, that the money's the employee's money's immediately, as well as another disadvantage is there is a lower cap on the contributions that you're allowed. Any questions on a simple IRA before I kind of jump into the next one? All right, so we'll keep moving on here. So we're going to talk a little bit about 401k plans, and we're going to spend a little bit more time when it comes to 401k because there's a little bit more design and a little bit more pieces to it. So 401ks, there's quite a few different components to it. And the nice thing about 401ks is that they can be very flexible based off of your company needs and what you want. So the first part when it comes to a 401k is the employee contribution. So the current maximum contribution an employer can make is $23,000. An employee can make is $23,000 a year. They can do a catch-up contribution if they're over age 50 up to $7,500. The max contribution that can be made is $69,000. So that additional contribution can be made by the employer. And the way that they do that, and as an employer can make that additional contribution, is through an employee match and adding possibly what's called a profit sharing to it. So I'll talk a little bit more about the profit sharing as well. Now, when we look at setting up a 401k, the things that you have to understand is these ones are highly regulated. But the one things that they're going to be looking at as far as regulation is that you're not trying to benefit the highly compensated or owners greater than you benefit those that make less or are not considered highly compensated. And so they're going to put several different rules. And so one of the things that I that I run into when I was working with employers, and I have a plan that I'm working with right now, is that this group had 3 owners. And the 3 owners were limited to where they could make very small contributions. And instead of being able to make the full $23,000 contribution as an owner, they were only able to make a contribution of about roughly $5,000 per year each. And the reason that they couldn't make a larger contribution than that is that their employees weren't contributing enough. And so they just had a standard traditional 401k. And because their employees weren't contributing to the plan, when they ran the compliance on the plan, the compliance told them as employers that they had to limit their contributions because their employees weren't participating enough. And so in this situation, the employers wanted to find a way that they could contribute more. And so what we're going to do is we're going to add what's called a safe harbor clause to their plan. So a safe harbor clause, what it does is it commits the employer to provide a certain amount of contributions to the employees. And if they add the safe harbor clause, what it does is it simplifies that what they call non-discrimination testing, or the highly compensated discrimination testing, to where it's not as big of an issue. And so if they add that safe harbor, they could make that full contribution of $23,000 a year, even if none of the other employees participated. And so that's one of the biggest mistakes that I see is, unfortunately, some plans don't put on that safe harbor part. And who gets harmed in that is the highly compensated which tends to be your key employees. And so if you have key employees that want to participate in the 401k and they're limited because other employees aren't participating, you may want to consider adding that safe harbor clause into your plan to make sure that those employees are happy, because they're your key employees. Yes, they're making a higher income, but we need to keep them happy because most likely they're the ones that are helping your company run, helping you on the sales side. Very important employees for you to take care of. On the other hand, also, if you're an owner and you want to be contributing, doing that safe harbor, make sure that you can contribute as well. Now, the differences between a safe harbor or a traditional plan comes down to the contributions of the employer. So we're going to first start off with a 401k. You have no requirement as an employer to contribute. Okay, so you can just set up a plan and you can make it to where it's 100% employee contributions. You're probably not going to get a lot of participation with a plan like that, but that is something you absolutely can do. Now, you can also have a plan and you can make changes on an annual basis, and you could say, I'm going to make this adjustment to where we are, yes, making contributions or not. Now, you have to make sure that you give notices if you're making those changes, but you're also able to make changes to that contribution on an annual, each annual year. Now, the other part of a standard 401k plan is you can put what's called a vesting schedule. So the vesting schedule is when does the employer contributions become the employee's guaranteed money. And so you can put up to like a 5-year vesting schedule, meaning that 20% of your contribution becomes their money. And as soon as they've worked a total of 5 years, then they receive 100% of contributions moving forward. So every year that they work, they get 20% more of the contributions moving forward that you put into their plan. So the nice thing about a non-safe harbor is you can throw in that vesting schedule. The disadvantage of a non-safe harbor is it can really limit the employee contributions and the employee happiness of those highly compensated or the employers being able to participate. Now, when it comes to safe harbor, what really gets eliminated is that vesting schedule. So as soon as an employer puts a contribution into that employee's account, that money is 100% their employee. So the vesting schedule is taken away. Now, with that safe harbor, there's a couple other keys and components to it. So you can pick a couple different ways that you want to contribute. The one that I see primarily is the 4% contribution. So what happens is the company gives a dollar for dollar match up to the first 3%. And then after that, if an employee puts in 4%, the employer puts in 3.5%. If an employee puts in 5%, the employer puts in 4%. So if the employee puts in 10%, you're capped at 4%. That's typically what we see as one of the more common ways that employers bring in the safe harbor, is that they say, hey, you do have to at least participate in order to get a contribution. And we're going to say that you have to put in 5% in order to get our full max contribution. Now, the other plan that I work with a lot is there is those employers that want to contribute to everyone regardless. And that's when you can put in a 3% contribution. And so what that 3% contribution, it's very similar to like doing the 2% for the simple IRA. You can give 3% to everyone regardless whether they participate or not. And so that 3% contribution can make a lot of sense. Typically, if you're going to add what's called a profit sharing component on there, or if you just want to make sure that you give that extra benefit to the employees. The group I'm working with right now, we're changing to the safe harbor, and they just want to make sure that every employee has a retirement plan. And so they've kind of built it into their compensation model that they're going to do a 3% contribution to everyone's retirement plan as part of their compensation program. And so that's what they want to have, and that's what we're going to build into their safe harbor. And they're not going to use profit sharing. But sometimes you get those employers that want to be able to contribute more to themselves. And that's when you bring in a profit sharing component. So what a profit sharing component is, and this can be built into 401k plans of all kinds, is where you can make an additional contribution if you want to. And you can make that decision each and every year, and you can make it up till your tax filing deadline. So for example, for 2024, you can make that decision all the way up until you file your taxes. I had an employer I'm working with that just made their decision in July if they were going to do the profit sharing, because they did an extension on their taxes. So with that profit sharing contribution, I'm not going to go into a lot of details of how the contribution works, because there's 3 different methods to determine how you're going to contribute. But basically, it can become it's going to be a percentage of everyone's salaries or everyone's incomes that you add in addition to what you're already doing. The nice thing about those calculations is that they can be weighted towards the owner or towards the highly compensated if you want to. And so there's, with the 3 different methods that you can use to calculate it, you can make sure the money of the profit sharing is going to who you want it to go. And so profit sharing can be a good way for employers to really try to maximize an extra contribution above the 23 or 30, 23,000 plus a match inside of there. So 401ks, one of the biggest advantages of 401k is that flexibility. Okay, you can also do flexibility on when the employees can become eligible to contribute or eligible to receive the match. Typically, what we see as a very common eligibility rule is a 1-year wait where the employee had to work at least 1,000 hours. Okay. So you can also make it where they're eligible automatically or after 3 months or after 6 months. But the maximum wait that we typically see, especially in the safe harbor, is 1,000 hours or 1 year before you have to start contributing to them. The disadvantage of a 401k is you have to deal with testing each and every year. And so there is a tax filing form called the 5500 that has to be filed annually. And that 5500 is going to let the IRS know about your contributions that you made and whether you were compliant in making the proper contributions each and every year. So what we typically see is with the 401k is that you have a team of people that help you with the 401k plan. The first person that's typically helping you is the record keeper. So we're going to go over a couple of these different terms because they may not be well known across the board. But a record keeper is typically the company that's responsible for your investments. So they keep track of the investments, they keep track of the contributions, they'll keep track of the loans. They're the places that people make trades. So Fidelity, Vanguard, American Funds, Nationwide, Principal, Empower, so on and so forth. There's thousands of companies out there that act as that record keeper. The next component of a 401k is called a third-party administrator, okay, or a TPA. The third-party administrator deals with the compliance or deals with the testing. Now, there is some plans where the record keeper can act also as a third-party administrator, but we're seeing more and more people are hiring a separate person to do the third-party administration than using the record keeper to do both. But just so you know, you can shop to see which way is the best for you. Okay. As far as the third-party administrator, they're the ones that complete your 5500 for you. They're the ones that will test everything to make sure you're staying compliant. It's extremely important that you have that individual, whether they're with the record keeper or they're on your own, to make sure that you stay compliant and that you don't get yourself in trouble with the IRS or the Department of Labor inside of there. Any questions so far on the 401k? Okay. We'll keep going on. The other benefits of a third-party administrator is they also help you, because within a 401k, we tend to see is where loans, hardship withdrawals, things like that also have to be calculated. And so a third-party administrator will monitor that and make sure that you're very compliant in those areas as well. Now, because you have these additional people, we tend to have a little additional fees. And so when you're comparing the 401k to a simple IRA, the simple IRA is also going to have someone similar to record keeper. Who are you choosing to make your investment choices with? And that person's going to be charging fees for those investments. Very similar, the record keeper is also going to be doing that. And so the record keeper has that individual that picks the different mutual funds, and there's going to be fees associated with those mutual funds. Now, the third-party administration typically is kind of an annualized flat fee. Typically, I see those numbers between $1,000 and $2,500 to $3,000 a year. And so one of the disadvantages of a 401k is there tends to be a little bit extra cost in a 401k over simple IRA because of the compliance testing that's required of a third-party administrator. And so that's one of the things that you have to consider is what's important. Yes, on a 401k, I can make higher contributions than a simple IRA. However, I'm going to have to do this extra testing that's involved with it to make sure that I'm protected. So there's a couple other things that I typically recommend that you have, and that's also in addition to this. So there's a fiduciary responsibility. Really, when it comes down to all of these plans, you need to make sure that you're, as an employer, you have the responsibility that you're finding a plan that's reasonable in cost and has quality investments. And so you have those responsibilities, and your employees can sue you if you are not getting a plan that is reasonable in cost and that the investments aren't up to a higher quality. And so you really need to make sure you're working with an advisor or a record keeper that's helping you stay compliant in this. Now, when it comes to a 401k, there is called an ERISA 321 or ERISA 338 that you can add to a 401k. And what they do is that this is where there's a team that will help you make your investment choices that are available in the plan for your employees to help you take care of some of your fiduciary responsibility. So in a 321 relationship, you'll work with an advisor and they'll come up with a list of investments that they recommend. And then the ERISA 321 will test your investments and tell you if they are quality investments or not. And each and every year they'll run a report and let you know if you should change one of your investments or not, if they are not compliant or not. Now, if you choose a 338 service, they're kind of a take care of it all service. So what they do in a 338 is if a fund is out of the quality measure that they're using, they'll replace it for you. So 321, you have the responsibility of replacing it, but they will notify you if you should. A 338, they're going to automatically replace it. So with a 401k, the things that you're going to also have to remember is that you have some fiduciary responsibility that you have to take. But there is services out there that are very low in cost to help you cover those things. Any questions so far on 401k before I keep moving forward? All right. So some of the things that we typically see that are some problems with 401ks because there is that compliance is that sometimes plans become outdated. For example, there was a Secure Act 2.0 recently came out in the last couple of years. And so a lot of 401k plans are having to be updated in order to comply with the Secure Act 2.0. And this is where a third-party administrator really takes some responsibility, and their job is to make sure that you keep your plans updated. In fact, they will every so many years require a restatement of your plan document. Okay. So I'll come up to that question. I thank you, Chris. So we'll get right to that just after this slide on there. So the other part is the failure to what they call benchmark fees. And so again, you have a responsibility from time to time to check to make sure that your plan is not being charged too much when it comes to a 401k. So with that, what you should do is you should work with an advisor, and every so many years you should quote to make sure your plan's fees are still in the proper threshold. And so just to quote, check with other plans, because unfortunately there's some plans that their fees don't decrease as the plan size gets larger. So typically on a 401k, as the assets inside the plan get larger and larger, your fees that you're paying should get reduced percentage wise. So maybe they start off charging you around a 1% fee, and that's a thrown out hypothetical number. But as the plan size gets bigger and bigger of assets, then what they're going to do is they would typically drop that fee down to maybe 0.9% instead of 1%, and so on and so forth. So if your plan isn't in a set up to where your fees decrease as the assets grow larger, you're going to definitely want to be shopping your 401k every so many years to make sure that you're priced correctly for your plan. Okay. Self audits, with self audits, one of the things you need to make sure, and this is actually where a TPA is going to help you out, is every year with the TPA, they should audit to make sure the contributions were done properly and make sure things were done on time. I see a lot of mistakes sometimes with companies that whoever they're using for payroll, whether it's internal, external, but they don't make the contributions on time. And so there is a responsibility to make contributions in a very timely manner. Other things that we see that people don't do is if they do make a change, they just make the change and they forget to document it. So whenever you make changes in any of your plans that you do, I highly recommend you take a time and write a little bit of note of why you made the change and why you thought it was beneficial for your employees. Documenting changes is extremely important because if the Department of Labor ever comes knocking on your door and they asking you questions, you'll have a way that you can look back and explain why you did things for them. Another one is we're going to talk a little bit about multiple employer plans in just a second. Multiple employer plans can be a way that you get some reduced expenses. So Chris asked a question. His question is, what's the process like for a small business that starts with the simple IRA but wants to transition to a 401k as business grows? Good question. So you can change from a simple IRA to a 401k plan. The one thing that you have to be careful in your transition is when you do it. If you want to transition to a safe harbor 401k plan, you need to make sure that you do it earlier in the year. There's typically these companies will stop doing new plans into a 401k right around the September, October timeframe, because there's some compliance rules that you have to give employees enough time to contribute to a plan. Okay, so you can transition during year from simple to 401k. What I would typically recommend is that you consider the fees and when's the right transition as far as contributions. The other thing that you're going to have to consider is that you will at that time when you're transitioning from a simple IRA to a 401k plan, your employees don't have to transfer their money in the simple IRA to the new 401k. So why is that a disadvantage? Because 401ks will charge you based off of how big the value of the accounts are that they're managing. So the bigger the account is, the lower your fees are going to be. And so if the employees that are in the simple IRA decide that they don't want to transfer or roll over their simple IRA to the 401k, you may be put in a a higher fee category because there's just not enough assets coming over. So there is that small disadvantage there, but you can do that transition anytime in the year, up to usually I would suggest you want to get it done in September. if not a little bit sooner. You don't want to wait till end of year, otherwise it won't transition till the first of the following year of January. So I hope that helped answer your question, Chris. If you have more question to it, just let me know. All right. So other things that we're looking at here is multiple employer plans. So because 401ks have that extra administration and you're thinking, hey, I don't want to have a lot of responsibility. I would like something a little bit simpler to deal with. Or you are saying, how can I reduce my fees? Yeah, we're just getting started. Is there any way that I can get a lower fee to get a 401k started? And the answer is you can do what's called a multiple employer plan. So a multiple employer plan has one company that's basically started the plan, okay? And there's companies out there that you don't have to go searching for the other companies to work with. What you do is you work with a record keeper that specializes in these plans, and they'll group you together with other employers. And so we find the record keeper that deals with multiple employer plans, and you could get a discounted fee because you're paying based off of the asset size of the complete plan of the multiple employers. So there's the big benefit that comes with it. The other thing is whoever started the multiple employer plan, they're the ones that have the responsibility for doing the 5,500. They're the ones that have the immediate responsibility of making sure the fund selection's good. So you have a little bit less fiduciary responsibility when you're dealing with a multiple employer plan. Now, the one thing you do have to remember, though, is the employer still has a responsibility to make sure that they're getting into the best multiple employer plan for the employees. So you will not lose your fiduciary responsibility by signing up with one of these, but you have a little bit less risk because you're inside of one of these. Okay, so multiple employer plans can be quite flexible, but the flexibility is you finding the right plan you fit into. Once you get into that plan, you lose your flexibility because the design that plan has is what you have to comply with. If you want to make a change to how the plan's designed, you're going to have to leave that multiple employer plan and go to a different plan. So it can be a good way to get started and then eventually transition to something else. Or it's a plan that you can be very happy with and just continue to build your assets inside of there. So when we look at kind of some of the differences between a single employer 401k plan versus a multiple employer plan is realizing that a single employer plan has a little bit more fiduciary responsibility, but it comes with a lot more flexibility. Okay, so that's one of the nice things. The administrative cost could be a little bit higher because it's just one employer plan. The multiple employer plan, we could possibly get a little lower cost because we have multiple companies participating. You have a little less fiduciary responsibility, as well as you have a little less paperwork because you're not having to worry about like the annual 5,500s inside of there. So it's a good plan for you to really consider as something that you can go with in addition to it. Okay, so when I look at things, I always tell people that you have to take into consideration when you're picking a retirement plan is, can you continue to make the contributions that you plan now? When we're wanting to retain employees, it's easy to give employees extra benefits to make them happy, but employees become very unhappy when you take benefits away from them. So make sure that whenever you're starting a retirement plan, make sure that you're ready and that you have a good financial situation where you can continue to make those contributions moving forward, because you don't want to take it away from them later. It's going to make them unhappy. Okay, the other thing that you want to look at is how flexible do you need to have it? Do you need to have the flexibility of 401k, or is it more important to you to have the reduced fees of a simple IRA? Or are you a small company and a SEP IRA is something you just want to do on an annual basis that's a little simpler for you to do? So kind of realizing there's lots of flexibility and plans to choose from that can help you get started. Now, I talked to you about the Secure Act 2.0, and I wanted to cover that just a little bit as I end my presentation today. So the Secure Act 2.0, one of the things that they put in there is some incentives for companies to start a retirement plan. They they want to incentivize these small companies. So if you have less than 100 employees, there's some benefits if you want to start a retirement plan. And these are going to be tax benefits. And the tax benefits come in a couple different categories. The first tax benefit comes in the category of getting a tax benefit for giving a employer contribution to the employees. Okay, so what they'll do is for the if you have less than employees and you haven't had a plan in the last 3 years, if you contribute to an employee as an employer, they will give up to $100,000 tax credit to you, okay, for the first 5 years. Now it's up to $100,000. There's definitely some additional rules that I don't have time to go into there. It's a conversation to have with your advisor and your tax person or CPA about what credits would you be able to receive if you're looking at making contributions. And that's for the first 5 years. The other one is the startup cost. Whenever you're dealing with the 401k, there's typically some startup costs to get things started, whether that's writing the plan document through the third-party administrator or those additional record keeper fees. And so there's up to a $5,000 tax credit that you can get to help start a plan inside of there. So that startup contribution tax credit's more on the 401k side, where the contribution tax credit can be used for 401k, SEP IRA, or simple IRA. Okay. There's one other tax credit, which is called auto enrollment. And so if you have it to where employees are automatically enrolled, and there's additional $500 tax credit that you can make. So the government wants you to incentivize you to do these plans. It's a great time for you with these incentives out there to consider starting a plan. Whichever plan is right for you, work with your financial planner, work with your CPA, help come up with a good design that best fits your strategy. Okay. So I'm going to open it up to questions now. We have a few minutes left where you guys can ask questions about the different types of plans that you have. Here's my contact information. I'll be sending you each an email as well, just with an introduction and some of the brochures that we recommend. But do you guys have any other questions for me?
Quiet group today.
Thanks, Robert.
Yeah, thank you, Jonathan, for the presentation. Oh, here we go. We got one in there. Thank you.
All right.
The chat.
Let me see. Where did that one go? There we go. If you have an existing 401k plan that is only employee contributions, can we take advantage? So no, since you've had a plan in the last 3 years, you can take advantage of that tax credits. From my understanding, if you want to follow up with your CPA on that question, I would highly recommend is there the IRS professional. But I don't believe you'll be able to get the tax credit on the employer contribution since you already have a plan. Okay.
Excellent. Great questions. Yeah, thank you, Jonathan, for being with us again and sharing that great information about retirement plans for businesses as they plan out for the employees and themselves. Again, Jonathan has some flyers he's going to be sharing with you for all those that attended, and we'll also post those on our content library with the recording of this webinar, so you can access those materials. Since we don't have more questions, we'll go ahead and wrap up a few minutes early. But again, I want to thank Jonathan for the presentation. He posted his email there in the chat, so you can access it. And with that, we will go ahead and wrap up, and we hope to see you next week on next week's boot camp. Thanks, and have a great day.
Thanks, everyone.